Hello, everyone, and welcome back to another episode. I'm your host, a millennial investor, and in today's episode, we're going over the big short that I just made. I just shorted $11,000 in put options worth of Tesla. Now, I know, hold up, before you start making rash decisions and opinions about me and saying that I'm making bad decisions and thinking that this is a mistake, it very well could be, but I want to at least give you my opinion and hear me out on why I'm deciding to do this. I currently have long positions in 3 positions in order from largest to smallest, which is Salesforce, Amazon, Crocs. Now, the reason why I'm buying Tesla puts is what this video is about and what we're going to go over. So we have a lot to go over in this video and about this company, so stay tuned if you want to watch this. If you haven't seen me before, my name is Jordan. I'm a millennial investor, and I showcase in every single video my portfolio balance, my performance, and as well as my holdings in the portfolio, as we just saw right there. And these are the 2 holdings that I shared down below in the description, which gives you detailed, descriptive portfolio holdings that I update every single video, which is down below in the description. And check out M1 Finance if you haven't already, which gives you $10 for signing up, and we've had 125 people sign up for it so far. So thank you for tuning in, and without further ado, let's go ahead and get started with Tesla. Now, what I'm going to show you here is a couple slides, and rather than go line by line, number over number, that can get very boring. You can pause the video if you want to look at any of this. This is on their investor relations page, and this is their most recent earnings numbers, okay? This is what some of their top line revenue data looks like, their bottom profit margin, their Tesla delivery vehicles, some of the metrics and key bullet points for what they're looking like throughout the end of 2022. These are some of the data-driven points that people invest in Tesla for, whether it's the market share of Tesla vehicles. Look at this right here. Between US and Canada, Europe and China, it's going up. Its top line revenue, its bottom line profitability is going up. Its FSD, its full self-driving and millions of miles continues to go up year after year after year, and that's not going to stop anytime soon. And then, of course, the most important of all, the Tesla vehicle deliveries continues to skyrocket. Look at this on a trailing 12 months, okay? All that stuff is great. And that brings me to actually Tesla stock, the actual stock itself. We've been talking about the company, but know what about the actual stock? In a 1-year timeline, the company is up 22%. On a 2-year timeline, the company is up 109%. On a 5-year timeline, the company is up 1,135%. So investors have gotten very bullish and have gotten very optimistic about this company. Despite the recession, even year to date, this company is only down 12%, which is not bad considering a time where if we go to SPY, the S&P 500 ETF is down 18% as of today. So Tesla is still beating the market in the recession, which normally this is the type of company, a high growth vehicle company, that would typically go down significantly in a recession. And that leads me to the reason why I'm shorting this company, which basically comes down to 2 main reasons. Now, what we're going to do here is we're going to hop over to Qualtrim, and we're going to look at what this company did in earnings per share last year. Last year, they did $1.63. Now, what we're going to do is we're going to give some optimistic, high-flying estimates for this company. I want to pretend that last year they did $1.63, which they did, and I want to pretend for the next 5 years this company will grow its profits, its earnings per share, at a rate of 50% for the next half decade. Now, to be fair, this is not really realistic in my opinion. Almost no companies can grow at 50% profit rates for half a decade straight, but let's pretend that they do it. 50% growth rate for 50 years puts this company's earnings per share at 12.38. Now, let's take today's share price of $307, okay? So we take 307, divide by 5 years out, earnings per share would be 12.38, and that gives you a PE, a forward PE in 2027 of 25. A 25 PE ratio 5 years out from now if they were hit these type of insane metrics. Now the question is, will they hit these type of growth rates? Well, let's go ahead and take a look at the estimates that Seeking Alpha has based off of Wall Street analysts. Based on this year, they're expected to about double their profits, their earnings per share, up 88% from the previous year. Next year, it's expected to go up 37%. The following year after that, it's supposed to go 19%, and we'll see where it goes on in the future. It doesn't go any further past that. But see how it's slowly going down from 88% to 37% to 19%. And now this is all expecting really optimistic metrics in a time when we're basically in a global recession. Whether it's the United States or China or Europe or really any country out there in the globe, pretty much across the board, pretty much every single country is in a recession, which typically leads to lower vehicle sales. Furthermore, I'd like to mention that every single day that goes by, while I think this will end soon, the shareholders are being diluted and shares are being issued in the millions every single year. Now, I don't think that will continue, but as of now, this company is still a very dilutive company, which is not good for shareholders. So considering that this company is at almost $1 trillion valuation, which I know is significantly higher than any other automaker out there, which I know that Tesla is a tech company, whatever, but just for comparison, one of the biggest ones out there on the planet, Toyota sits at under 200 billion, while Tesla, of course, sits at almost $1 trillion, about 5 times that. Now, I know that people don't like to reference Tesla as an automaker, it's more of a tech company, but the main reason why I'm shorting this company is this. It breaks it down to 2 reasons. The first one is, I think that there's a pretty reasonable chance heading into a recession that these numbers that are estimated, 88% profitability growth, 37% growth, 19% profitability growth. I don't think that this big number of 88% year over year is going to be hit. Because of issues with China, them basically going into a deep recession, possibly even a depression, with the United States starting to hit big slowdowns from interest rate hikes and lots of other not so good things happening in the short term, the main reason why you own a company like Tesla is because of its massive growth rates. This company has grown a lot, and it's one that I've been a huge fan of and was even a shareholder of back in May of 2019. But this is not one that I think at $1 trillion market cap has lots of opportunity to run. Now, I do think that this company has a chance to stay flat and even stay reasonably decent in this market. But if the stock market were to fall, I highly doubt that this is the one that people are going to be fleeing to safety for. And this leads me to the second reason. The first one being, I think the stock is likely going to go down within the next year. The second reason is that no matter what happens, whether Tesla goes up, Tesla goes down, I have such an uncertain feeling in the market. And all of these companies, whether it's Crocs, whether it's Salesforce, whether it's Amazon, all of these companies in my portfolio I am long on. The only hedge I have is a little bit of covered call income. If these go down, my portfolio is very, very long heavy, like almost 99% before this. If the companies go down in value, if the stock market goes down, I have little to no protection. What I have here is an opportunity that if the SPY, the SPY, or the QQQ start to go down in value, if the market does in fact crash, Tesla, like all companies, is going to get dragged down with it. And since it's a high-flying growth name, it will likely go down much more than the average stock in the market, more than likely. But if Tesla goes down, these puts will protect me and provide some extra needed cash as these companies fall down so I can reinvest back into other holdings, other positions, or just protect myself and cash up when the portfolio is going down. If the stock market goes up, if I'm wrong, and the QQQ, if the SPY, all these indexes keep on going higher and they hit new all-time highs, then I will take my losses and the other positions in my portfolio will skyrocket and I'll make a lot more than I will lose from any Tesla short position. But regardless, no matter what happens, guys, I think that this is an opportunity unique to me. If you're watching this video, this doesn't mean that you should do it. I'm not recommending that this is financial advice or you should do this yourself. I am very concentrated in my growth portfolio in just a few positions that are very high-flying names, fast-growing companies, and a company like Tesla is the same, which is why I'm trying to short it. This is to protect myself. This is to give me some sort of hedge if the market goes down. This is not even so much a disbelief in the company. I think the business, the company itself will do fantastic over the next decade, but I think in the short term, in 2022 and going into 2023, I think Tesla's stock price has some room to fall, and I hope that I'm right on that. Trading at almost $1 trillion market cap with little to no downturn in a time where we're in a recession and this company's valuations continues to stay elevated, I'm just not so sure how much longer that can stay. But other than that, guys, thank you so much for watching. I appreciate you watching all the way in. Check out all the stuff down below in the description if you haven't already, and get signed up with M1 Finance to get $10 and help support the channel. But other than that, guys, thank you so much for watching, and I'll catch you guys next time.